Breaking the Mould, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you?
Very well, Clara. How are you? It's lovely to see you again.
It's lovely to see you
Thank
as
you
well.
so much.
I'm looking for the sunshine, but it's not here yet.
Kind of. Bit better.
Is there some other fuss that we need to know about, Russ?
Well, there is, but with the greatest respect to full year numbers from FTSE 250 real estate player London Metric, Chester's identity data expert GB, and an annual general meeting from Gem Diamonds in the first few days of June, it's a bit quiet on the corporate front right now. So I actually reckon the real fuss is, again, going to come from the macroeconomic side. And that means it's all eyes on the latest big survey from the USA, interest rate decisions in the UK and Europe, and headline jobs figures from America.
Okay, so let's
Try to look a bit more enthusiastic, won't you?
The American survey.
Okay.
I guess we're talking something about beige here.
Beige, very good, yes. Wednesday the 3rd of June, America's central bank, the Federal Reserve, releases its latest beige book, or to give it its really thrilling full name, the Summary of Commentary on Current Economic Conditions by Federal Reserve District.
Oh, you're really talking my language this morning, aren't you?
There we
I'm
go.
really enjoying
Now,
it.
as the rather long name suggests, the document's a collection of anecdotal evidence from the Fed's 12 economic districts. And it does, I promise you, provide some interesting colour on the world's largest economy.
It does sound very exciting. That's a lie, it doesn't. The name's not very exciting, but it is very important stuff.
It's extremely important, particularly because we've talked a lot on here about how America's economy had a really soft patch in Q1, growth of just 0.2%, and the Atlanta Fed's GDP Now survey is only forecasting 0.9% for Q2. Now that's not really the sort of bounce back that people were expecting when oil was weak. The chart here shows US GDP growth by quarter over the last 5 years. Now bad weather, a port strike, strong dollar all hit the first quarter, but again oil has not helped. Consumer spending has perhaps ticked up, but that's been offset by lower work and capex in the oil industry, and so overall US momentum has flagged. Now you can see this if you go a bit more locally, which is what the beige book's all about, and we've got charts here that will look at optimism, corporate optimism surveys from the Dallas and Kansas City Feds, both oil exposed states. Now optimists will get a bit more excited about the Empire State, New York, and Philadelphia, and they're showing a little bit of improvement after a pretty weak Q1. So again, let's see what the beige book says. Here's the Big Apple, the Empire State, and then after that, the streets of Philadelphia. So if America's economic progress remains tepid, and those charts aren't brilliant, the Federal Reserve may hold off on interest rate increases. Some analysts expect the first increase in borrowing costs in September, some in December. Let's see. Now the longer money stays cheap with rock bottom rates, the more supportive it is, in theory, for stock prices, and particularly those assets that generate a reliable income, although history shows valuations can only go so far. Anyway, we'll see the beige book, and then on the 16th and 17th of June, we get the next Fed statement.
Yeah, okay. But before that, we've got the European...
Yes, we
Bank
have. You're
and
still
the Bank
awake.
of
Yes,
England.
good. You've hung tough with me so far.
I was just checking.
Yeah, we've got the ECB's latest monetary policy announcement on Wednesday the 3rd, and the old lady of Threadneedle Street, the Bank of England, the day after Thursday the 4th. Now, neither big bank boss, Mario Draghi, or Mark Carney are likely to change policy, although the ECB has responded to the upset in the bond market I talked about last week by saying it might accelerate its bond buying programme during the quiet summer months to try and see things through. Now, the ECB's headline interest rate is 0.05%, and the QE programme is still running at €60 billion a month to September 2016. The UK stopped adding to its QE programme 3 years ago, and it's kept its headline base rate at 0.5% for over 6 years. Not bad for measures that were described as temporary at the time, and the market now isn't expecting a rate hike in the UK till probably 2016.
So we've done surveys and central banks. That just leaves us with American jobs.
American jobs, and on its non-farm payrolls on Friday the 5th of June, perhaps the single most influential economic statistic. If you're a trader, anyway. If you're a long-term investor, you probably don't give a hoot, and perhaps quite right too. But just in case, the number for comparison is the 223,000 jobs added in April. We're going to get May's number. Now we know that, again, the first quarter wasn't very good, so people are looking to see if the US is back on track with a strong non-farm payrolls number. The bars is the non-farm payrolls number. The line is the unemployment number in the US on a 3-year view. But remember, this is a lagging indicator. Just think how long it takes your firm to feel confident enough to increase headcount and then actually go out and hire somebody.
Yeah.
It's a real fiddle, it takes ages. So although the unemployment surveys are interesting, the job surveys are interesting, the sentiment surveys we talked about right at the start, which don't look quite so good, are probably a lot more important.
Okay, thank you, Russ.
Pleasure.
And thank you to you for joining us. We'll see you next time. Goodbye.